Hi guys, this is Chris Maxwell with the Fire Me channel, and today our video is going to be on setting up your very first stock portfolio. Now, this video is not going to tell you what to buy and what you should buy and all the rest of that. It's going to basically give you some ideas about how to structure your portfolio when you're first starting out, and some ideas on things and why you should or maybe shouldn't do other things. And yeah, so let's get started. All right, so how do you even start building a portfolio, and how do you start investing? And so this is for someone who has $0 to up to say maybe 25,000. So you only want to have about 5 stocks max in your portfolio at this point. Now the reason for that is diversification is great, but over diversification can be just as bad as not having any diversification at all. There's a bunch of reasons for that, but basically you only want to start with a handful of stocks that you like, that you can follow, and what you're going to want to do is have them all equal weighted in your portfolio at this time, and you're going to build this base or this foundation up to your wealth. So you're going to get 5 high quality stocks, build them up equal weight up to that $25,000 level. That would be my advice when you're first getting going, and you're only going to want to build one position at a time. Now the reason for this is because of dividends. Now it ties into the second point of make sure you're in the dividend reinvestment program. So let me explain what that is, and we'll circle back about building one position at a time. So the dividend reinvestment program is basically when you get your dividends from any given company. If you're on the DRIP program or the dividend reinvestment program, that money will automatically reinvest back into the shares, commission free, of the company that you own the shares for. So when I say build one position at a time, the reason why that is important is because when you're first starting out, you don't have a lot of equity. You're going to build some shares up into a company. More than likely it's going to be a bigger company, it's going to have dividends, and when you build that one position, you can hit that critical mass point on the DRIP where you're actually getting enough dividends that whenever you get paid that dividend, it automatically reinvests, gets you another share of that company. And that's really important for long-term compounding and growth of your portfolio. So the key takeaway from this is get on the DRIP program and only build one position at a time when especially when you're first starting out, at least till you get to that point of the critical mass, what I call it, where the dividend reinvestment program is going to kick in and you're going to start getting more shares of the company at no commission charge to yourself. Now the one piece of advice I'm going to give anybody just starting out into investing is do not get into options or margin trading until you've got some experience. Options and margin trading are not for people just starting out trying to build their wealth, trying to get things figured out. So just stay away from that. I'm not saying they're bad things. I'm just saying they're a little more complicated than just buying shares and investments. So stay away from that up front. Learn about it, figure it out before you even think about getting into this margins and options trading. And we're going to be doing a whole bunch of videos and stuff on options and margins trading down the road, but for the purposes of this how to get started video, we're just going to leave it at that. All right, now the first thing you're going to want to do is identify the market segments that you're interested in, and maybe even some that you're not so interested in either. So when I say market segments, what I'm really talking about is things like financials is a segment, energy is a segment, healthcare is a segment, transports are a segment. There's many different market segments, but the key is figure out the segment that you're really interested in, or the segments that you're really interested in, or the ones that you think have a lot of growth, their growth potential, and that's what you want to get started to be invested in. The other thing is be open-minded about what segments you're willing to participate in, and the reason is you might not like a certain segment for whatever reasons, or maybe you're unfamiliar with it, but that might be the segment that is up and coming and that's going to do the best return for your portfolio. So I'll just give you an example. Say my grandma probably is not interested in technology or tech stocks or following that whatsoever. The companies that she grew up with and that she's interested in would be more like things like Campbell's Soup, Kraft Heinz, the staples that she knows. So if you're someone like my grandmother who really isn't interested in technology, keep an open mind. Maybe that's actually the sector you need to be invested in, because that's where all the growth is. So the whole point is keep an open mind about where you're willing to put your money. Now there might be some segments like what's called the sin stocks, so like casinos, liquor companies, cannabis companies, etc., that you want nothing to do with, and that's fine. But for some of these other segments that don't really have this moral underlying issues for some people, keep an open mind. The transports, maybe you've never thought about investing in them before, but maybe that's where your money needs to go. So that's the first step, really, is identifying the market segments that you want to be invested in. Now, if you check out our chart, this is just giving an example. We've got our financials, transports, energy, REITs, and technology all equal weighted in our portfolio at this time, just like we had discussed previously. Whatever segments we decide to be in or companies, we're going to keep an equal weight up front when we just get started here. All right, now potential investments. Now this is really interesting. So when you're first starting out, what should you be looking at as a potential investment? So now that you've identified the market segments you want to be in, the next step is really to identify what the best of breed companies are in those segments. So if financials was an area that you're interested in, JP Morgan is the best of breed. There's nobody will dispute that. If you're in the energy sector and you want to buy an investment in there, Chevron is is considered to be the best producer, I believe, right now. ExxonMobil wouldn't be a bad choice either. So basically, if you've heard of these companies and they're the biggest, best of the best, top tier, that's the companies you want to start with to build the foundation of your portfolio. Now, I'm not telling you what to buy. I'm not a personal financial planner, but it's up to you to do the research and really figure out what you want to be invested in and what you want to really put your money in and what companies you actually understand. The one thing to really avoid is speculative stocks hoping for an initial big win. I know a lot of people have gotten into portfolios where they put all their money in one stock. Maybe it's a high risk tech stock that if it explodes, they're going to double their money and kick start. But you know what? When you're starting off, just put your money in good blue chip companies that have a solid dividend, that are safe, and that you can start growing your wealth slowly. Now, the other thing too, I come back to this point. So you don't have to know how to do financial analysis to figure out what companies to be invested in. Now, what I'm really talking about on this is when you've got these best of breed companies, they're covered by a ton of analysts, like a ton. You can find, if you Google JP Morgan and today and look for some information on that company and what analysts think of it, you will have more reports than you have days to read them. So you don't actually have to know how to calculate a price to earnings ratio. You don't actually have to know how to calculate a bunch of these metrics and ratios. All that stuff's readily available. It's easy to find. It's done by some of the best analysts in the world. Just read the articles and really understand the company. So don't worry if you don't know how to do this in-depth calculations and financial analysis. There's other people that have already done that work for you. You just have to read the reports and really understand what you're getting yourself into. The other thing with these initial stocks too is these are really the building blocks of your portfolio. So I like to call them the pillars of the portfolio, and in this case we're going to have 5, and these are the pillars are strong, they are stable, they're not going to probably make you 100% return in a year, but they're also not going to lose all your money because they had a bad day on the market. So these pillars of the portfolio are really the foundation stones you need to be setting when you're first starting out investing. and just getting going and figuring out what you want to buy. And I know that's not the sexy thing, and it's not what a lot of people first starting out want to get into. A lot of people want to jump into these IPOs, and a lot of people want to jump into these high-flying tech stocks when they're first starting out just because it's exciting. But when you're getting the foundations laid for your portfolio, exciting is not necessarily a good thing. You want to get these good blue chip, big companies that are solid, that are going to help build your wealth over time. And the last point I have to make is choose companies that you're familiar with. So don't buy some company that you have no idea what they do and don't know the line of business. Buy what you know. That is a very important piece of all investing, but it's really important for people that are just starting out. Buy what you know. Do not get into an investment if you do not know that market. If you don't know that industry, just stay out of it. If you are interested in it, research it, learn about it, and then make your investment decision, but don't get into something that you know nothing about. Okay? All right, so potential investments. So this is how I would go about building up a portfolio from scratch. So first, we're going to identify the market segments, which is our category section here. So financials, energy, transports, REITs, technology, healthcare, biotech, staples, gaming, sin stocks, whatever categories or segments of the market that you're interested in, get them listed out. The next step is we're going to narrow that down to 5, and we're going to give those an equal rating of 20% each. So that'll basically be one company in each of those 5 segments. And so just for ease of demonstrating what we're trying to talk about, we've picked the first 5 segments, which would be financials, transports, energy, REITs, technology, and and technology. And the next section is potential investments. Now, for potential investments, what we're going to do is we're going to take the best of breed companies and list them out. So in financials, we've got JP Morgan, Bank of America, Citigroup. Transports, we got Delta, United, FedEx, UPS. REITs, Brookfield, Ventus, and Ventus isn't a household name, but it's basically a REIT that specializes in senior living. And then technology, we got Microsoft, Apple, Micron, Google, Netflix, all big companies, all companies you've heard of before. And the whole point of doing a matrix like this is it really lays out your potential investment opportunities, how big they're going to be in your portfolio, and then what your investment options actually are. So in the industry I'm in, we've got a saying that you plan the work, then you work the plan. So what we're doing right now is we're planning our work. Like, doing the trade is the last thing you need to do. The first thing you need to do is understand what you're buying, how you want your portfolio to look, and then the easy part is actually doing the purchase. So plan out your investments and know what categories or market segments you want to be in, know how much of your portfolio you want in each of those segments, and have a really good understanding of the companies and potential investments that you have in those segments to choose from. All right, so individual market segments. Now, so once you get a bunch of capital built up, and you say maybe you have $100,000 and you want to start diversifying, you really like the market segment that you're in, but you want some diversification within that segment. What you want to do is you want to be overweight in your core holding. So in this example, we've got JP Morgan the financials for our market segment. And for the holdings, we've got JP Morgan, and we've kept that at 85%. So we're staying overweight in that company. And we're also going to add some Bank of America and Citigroup at smaller percentages as a way to diversify the portfolio. So I wouldn't recommend even diversify, like if you're in a financials market segment, I wouldn't even recommend diversifying in that segment until you start getting a lot more money. Like, there's no point in having 10 bank stocks just for the sake of having 10 bank stocks. Have the best of breed, and the next maybe 1 or 2 that maybe have some potential for some growth. If you know something's coming up or you've been following them, you really like them, and you want to add them in, that's how you start diversifying within your market segment. And the key too is just to not over diversify, and the reason why is you can't follow that many companies as the average investor. So every one of us has a 9-to-5 job, and if we were working on Wall Street and the whole job was sitting there following the financial news, following companies, analyzing them, that'd be fine. But for the average person at home like you or me, we don't have time to follow more than probably 10 companies at the most. So you don't want to be over diversified. Buy the best, diversify a little bit within that segment, but just buy and own the best companies. And the other thing too is when you end up over diversifying, you end up becoming your own mutual fund essentially. So if you own 150 different stocks, you might as well just own a mutual fund, because the effect is going to be the same thing. So diversify, but not to the point where it's going to make you your own mutual fund. All right, so in summary, we are going to be looking at 5 market segments, 5 stocks, so 1 stock per segment. We are only going to be taking a look at the best companies with no speculation at this point. Remember, we're just starting out our portfolio. We want to get going. We want good companies, solid earnings. We're going to build 1 position at a time, because that is what will let us get into that drip program the soonest. And we are going to buy what is on sale. So what do I mean by buy what is on sale? So in any given time, there's going to be certain industries, certain sectors of the market that are really popular, really hot, really expensive, and there's going to be other segments that aren't as sexy and they're not what people are looking at. So right now, tech is really popular, it's really expensive, it's what everybody's interested in, it's high growth. However, something like, say, financials isn't really interesting right now. They're trading at a relatively low multiple. So when I say buy what's on sale, that's maybe your opportunity. Is you don't buy tech right now, maybe you buy the banks or something like that don't have a huge multiple on them right now, because there's really not a lot going on. So if you buy the stuff that is a deal and don't get caught up in the hype, that's going to be a lot better for you long term, even though it might not be as exciting in the short run. And the other thing too, when you start building up a portfolio from scratch, you're going to, and you're probably not someone that has a lot of knowledge when you're just starting out. Like if you have no money and you're just putting in like a $50, $100 just to get your initial net worth built up, that's the time when it feels like things are moving slow, you're not able to buy a lot of shares, things are kind of plodding along. Use that time to build up your financial knowledge. So really understand or start learning and understanding what all these investment terms mean, what your options are, how to evaluate these companies, because it won't take long before you actually do start getting a substantial amount of money. And when you do, you're going to want this financial knowledge to be able to manage it properly, manage it better. And lots of people will say, well, I'll just use a financial advisor. But how do you know that they're giving you the best guidance for you personally? So I'm a really big advocate of building up your own financial knowledge and acumen, and understanding the industry, and watching shows like CNBC to really build up some of your financial knowledge. Now, the last thing for the summary is stay the course. So like I'd mentioned previously, it's going to take a long time to build up money when you're just starting out, because your dividend income's probably not that significant. Most of the money is going to be self-funded, and it's going to take a while for your portfolio to really get rolling. But stay the course. Once you start accumulating a bit of money and that money starts reinvesting in itself, you're going to really see a significant portfolio jump with relatively short period of time. So just stay the course, don't be discouraged, and make sure you pick good companies in the industries you actually want to follow and are interested in. So anyways, that's about all I got for today, guys. So give the video a like, remember to subscribe, and leave your comments below. Yeah, I'd love to know what you guys think about some of the tips I've given you, or if you have any tips of your own. I'm always interested to hear what other people are interested in and have to say. So anyways, that's it for this one, and have a great day.